Hi, what's up, guys? Welcome back to another Wise Wealth. This is probably be on the shorter side of the videos, but I'm gonna see how you guys like the presentations compared to the drawings. So we went over DCF. Now we're gonna do comparable company analysis, and these are just examples of how it looks. So comparable company analysis. What is it? It's a process that's used to evaluate the value of a company by comparing it to other similar companies, such as similar products, similar location, similar size, and you compare it by using multiples like the EBITDA, the PE ratio. You could use the price to book ratio, and yeah, the main thing is you have to choose it within the same size or the same like field, or else if you don't, it's your comp is gonna not be accurate. Now, what are the valuation multiples that are used? You could use the most common ones: enterprise to sales value, or EV divided by S, price to earnings, price to book, price to sales, and enterprise value to EBITDA. And when we say sales, the sales is simply just how much money the company makes, the total revenue of the company. And this is how you get the P ratio, share price divided by earnings share. And this is just what EBITDA is, which we went over in previous multiple videos. So enterprise to sales. An enterprise value is just a measure of a company's total value. And this is the formula for the enterprise value. You can take the market cap plus the total debt, and then you minus the cash and cash equivalents. How do you interpret the enterprise to sales value? A lower enterprise to sales ratio or multiple may suggest that the company is undervalued relative to sales, and a higher enterprise value to sales ratio may suggest that the company is overvalued, or investors are willing to pay a premium. Now we can go to the price to earnings ratio. The formula for the P ratio we showed it in the first slide. Just market price per share divided by the earnings per share. And how do you interpret a P ratio? A higher P ratio suggests that the market expects future growth or willing to pay a premium for the stock. However, a high P ratio could signify that the stock is maybe overvalued, so you have to be careful on the P ratios, which is why you use multiple ratios and multiples when you're comparing companies. You can't just use one. A low P ratio may indicate the stock is undervalued or the company is experiencing difficulties, such as not being able to pay back loans or not making enough sales, whatever it is. Now, the price to book ratio. What the book is, it's the value of a company's equity, and the book value you get by it's very simple: assets minus liabilities. Price to book equals the formula is market price per share divided by book value per share. How do you interpret these? A price to book value less than 1 might indicate the stock is undervalued and market price is less than the book value. A price to book equal to 1 is that the market value of the company is at or equal to the book value, which is likely to probably never happen, but if the price to book value is greater than 1, the company may have strong growth potential like, you know. And price of sales. This one's pretty self-explanatory. You take the market cap and you divide it by the total revenue. How do you interpret a price to sales ratio? A low price sales ratio may suggest the stock is undervalued relative to its sales, and a higher price sales value may suggest that the stock is overvalued. Pretty simple. And the final multiple is the enterprise value to EBITDA. And obviously, EBITDA stands for earnings before tax, depreciation, and amortization. And how do we interpret this? A low ratio may indicate the company is undervalued relative to its earnings potential, which could present a good buying opportunity. And a higher ratio may suggest the company is overvalued. Now, what are the steps to conduct a CCA or a comp? The first thing you have to do is select companies that are comparable. So we have same industry, same size, same location, same products, all of that. You have to make sure that the companies are similar. The second thing you do is get the financial metrics, such as the revenue, the cash flow, market cap, EBITDA, whatever it may be. And then you get the valuation multiples, which we just went over. And after you get the valuation multiples, you apply the multiples to the target company. And then you use a median of multiples from comparable companies, so companies similar to the target company, to estimate the target company's value by applying the multiple to the corresponding metrics. And then after that, you have to adjust for the differences, such as taking into account growth prospects, risk factors, and whatever the market conditions may be. And basically, the main idea here is just that if a company's valuation ratio is greater than its peers, it's said to be overvalued. And if the company's valuation ratio is lower than its peers, it's said to be undervalued. So, for example, if let's just go with Google, Apple, and Microsoft. If Google's valuation ratio is greater than Microsoft and Apple, it's said to be overvalued. Overall, we got comps are widely used in investment banking, private equity, and corporate finance and venture capital to provide a quick and fast assessment of the company's value relative to peer companies. And a comparable company analysis is just another good way to determine if an investment is worthwhile. All right, that's it. Thanks for watching. I'll make another video on the next video will be precedent transactions. Thanks for watching.